All right, welcome to Fundamental Trends and Margin of Safety Investing with Kirk Spano. I'm an investment advisor with Blue Mound Asset Management in Wisconsin, and I do these webinars each week to try to help make sense of the markets, and depending on the topic, sometimes we'll deal with macro issues, sometimes central banks and government, sometimes company and sector fundamentals, and other times price trends. Today we're going to try to um, go through a number of things having to do with the volatility in the market, and I'll take some questions, but I really want to just focus on ways to trade this market that really will simplify things. And when you think about market structure, which I'll explain in a second, it'll really make sense to you why I do what I do for trading, which I don't trade a lot, but sometimes when the market gets volatile, it makes some sense to make some trades to upgrade your portfolio. So we will do that right now. And first slide, pretty easy, is dealing with volatility. So slide 2, we want to take a look at the S&P 500 here. And as you can see, pretty good trend here during 2017, which was the lowest volatility year on record. And now coming into 2018, we are having a lot of volatility to start the year. And that, I think, is probably to be expected. I think that if we are going to get a return to volatility, which does appear to be the case, then we have to have some smart ways to trade around it. But I would caution you from getting too paranoid. Although this looks kind of ominous, the reality is the market goes up for long periods of time, for years at a time when it goes up. When it comes down, it usually comes down pretty quick. This took a few years, but this took 9 months. I believe that the next big correction will be quick, and I think these small corrections, these 10 to 20% corrections, will also be quick, and here's why. Market structure isn't what it used to be. It used to be that fear and greed ruled the markets. That is actually different this time, and I hate to say it's different this time, but it is. And here's why. The algorithms, the computers, are controlling about 3/4 or more of the trading on any given day. So it's really not you and your neighbor and a bunch of people running to buy and sell anymore. And that can be seen a number of different ways. First of all, we know that the computers trade 3/4 or more of the market every day. We know that. But we also know that most humans are moving away from a trading style that can get them in trouble because they've just thrown in the towel, and now you have more and more people indexing. And that adds to a peculiar market structure as well. So the structure of the market is different than it was when I started 20, 25 years ago. We really have to be aware of the impact of the computer trading and not let our emotions get in the way. So we want to have a systematic way of trading this, a way of picking up the companies that we think are going to be leaders in the next decade, a way of generating extra income for portfolios, and a way of staying out of trouble. So with that, I will move on and talk about some of the places that the stock market could go, and then we'll talk about how to deal with it. First of all, you've seen this chart before. We are up here. This chart's a little bit older, but we're testing the 200-day moving average again, and today we're doing that again. If the 200-day moving average closes on the weekly chart below 200-day moving average, then that's generally a sign that we're going to see some follow through. So it's just like breaking resistance to the upside. You get a breakout. If we break below the 200-day moving average, that's generally seen as a breakdown, and we'll probably see some follow through. There are a number of support levels in here. However, the really big support level is right around 220 on the S&P 500. Could we lose an additional 10%? Well, I think that's pretty obvious that we could. So with what's going on with the tariffs and this little temper tantrum between President Trump and President Xi over in China, I think it's very realistic that we see 220 on the S&P 500 maybe in the next couple of months. So be aware of that. Do I see the next big one coming where we basically test the support of the two previous highs in the market? Do I see us going down to around 160 on the S&P 500? Probably not. We'd probably have to have some sort of recessionary pressures. Now, if we really do get into a trade war, which I've talked about in other webinars, then Katie barred the door. Then probably we're going down to the 1600 level on the S&P 500, because if we really have a trade war, then we're going to see a recession. And that's going to result in a lot of liquidity problems, a lot of debts getting delayed or not paid at all. And it could turn into a 2008 sort of situation. It shouldn't happen that way. And I wrote an article this week discussing why I think that there's more likely to be positive surprises than negative surprises with trade. However, we don't know really what President Trump will do and what President Xi will do. You would think the cooler heads prevail. However, they're both very headstrong people. And the thing that President Trump may or may not quite be aware of is winning a trade war with China won't be easy because they don't have a populace that's really going to turn on them, right? The president in China is basically now the president for life. They've changed the law over there. They don't have a lot of reason to bow to pressure. So they're going to do what they want to do, and we can't really hurt them that much. They can't really hurt us that much unless we hurt each other, and then we can hurt everybody a lot. So, you know, we should be looking for marginal improvements on the trade balance. We should be looking for marginal improvements in access to China's markets, marginal improvements on protection for technology. However, the idea that there is a lot of improvement to be made is just wrong. There isn't a lot of improvement to be made. You know, I know the people scream about we're losing wealth because of the trade deficit. No, we have a trade deficit because we're very wealthy and we can afford to buy a lot of stuff from a country that's making certain things cheaper than us. And when you take a look at how those numbers really work, the reality is that we are still marking things up once they get here and taking a cut here as well. So on net, you look at it from the size of the economy, and when you think about the fact that the United States and the Chinese economies are basically the same size, despite the fact that the United States has a quarter as many people, and you go, well, that's pretty good if we have the same size economy, but they're 4 times bigger than us. So think that through. We're a very wealthy country, and having a trade deficit with certain trade partners, and even most trade partners, just means that we're wealthy enough to buy more things. Now, does that mean that there can't be some improvements? Absolutely not. There are certain things that they ought to, of ours that we make, that they should be letting into China. They shouldn't be as protectionist as they are. And certainly they've been protectionist for a long time, owing to their more communistic philosophical view, even if they've become very capitalistic economically over the last few decades. So are there marginal improvements to be made? Yes. Are there small wins to be made? Yes. Should we be selling them more oil and gas? I think that's clearly going to be part of the negotiations. My article on Monday is going to talk about the oil and gas equation with regard to trade deficits and how to come to some resolution on these dueling tariffs. So we'll keep an eye on that, but ultimately I think this all washes out. I don't think that we end up having a trade war. However, my level of conviction is not terribly high on that because I, like everybody else, have a very difficult time measuring the mercurial nature of our president. How much of this is trade negotiation? How much of it is being a bully? How much of it is ignorance? There's a Republican senator called Trump stupid today. And, it's just hard to know. So I try to keep my emotions in check and have a system for protecting myself, knowing that we're probably going to see this 2200 level on the S&P at some point sooner than later. And eventually, someday, we'll see 1600 on the S&P when there's a real economic breakdown, which shouldn't happen now. But because of the mini trade war so far that could morph into a big trade war with unintended consequences, this could happen sooner than maybe it should. All right, so moving on. How do we deal with it? Buying and selling, limit orders, maybe the best thing that you can do. Stop limits for preventing losses are also good. If you want to lock in absolute levels. However, I'm more concerned with buying because I know in the long term, market goes up. And if you stretch out this chart going back another 100 years, you'll see it's pretty dramatic that periods of downtime in the market are short, measured in quarters or just a few years, and up markets are measured in years and, in this case, a decade. So if we want to buy stocks and we know about what price we want to buy them at and we know about where the support levels are in the market, we can generally take a look at the first standard deviation, the second standard deviation, the third standard deviation of where a stock trades, what its range is, and then depending on your risk tolerance, and in the very short list, which I'm not going to show here, we can pick out those support levels. The first major support level is really the moving averages, right? 50, 100, 200-day moving averages, and you go longer moving average, the longer you intend to hold stock. So if you're a swing trader and you're holding things for a month or a quarter or a couple quarters, you might use a shorter standard moving average. If you are a position trader like I am, generally holding things for years, you'll use the longer moving averages. So, I usually use the 200-day moving average, and right now we're testing the 200-day moving average, and if we break below it and close to the downside today, we might have to play a little bit more defense next week. So we'll see. But we do like to use limit orders so that when the stock market goes up, for example, the other day, it opened down 500 points. And if you had limit orders in, a few of our limit orders, I know for a fact, executed. And then by the end of the day, the market was up 200 points. So just by taking your hand off the clicker, putting a number in, and saying if it hits, it hits, and if it doesn't, it doesn't, you get the benefit of controlling your emotions, having a good price in there, and if it hits, great. If it doesn't hit, you live to fight another day. And a lot of those orders hit near the bottom of the market that day because we knew that was a test point, hitting the 200-day moving average again, and then the market came right back up. And a lot of people are sitting on 2 and 3% gains in 2 or 3 days. Man, if I could make a percentage point a day, I'd be the happiest guy out there. It's unusual, but the limit orders give you the ability to control emotions and set orders where you want them. I like to use options. Why do I like to use options? Because it gives me the ability to make smaller trades, have less at risk, and to collect income by setting a limit order. What do I mean by that? Would you like to get paid to set a limit order? Selling cash secured puts is a lot like that. I sell a lot of cash secured puts, and it's a very professional move. It's what a lot of professionals do. Why? Because put premiums are often very high because people are speculating on prices to go down, and therefore they'll pay more for the put. So if you're the put seller, you're generally getting paid a disproportionately high amount to sell a put to somebody. And if you like the stock, then that's when you do it. If the puts are cheap, that means that there's maybe not a lot of risk to the people who own the stock. So they're not bidding on risk. Now, there's exceptions to that. The S&P 500, the SPY puts were super cheap in December and early January. It was a good deal to buy SPY puts in late December, early January because they were cheap. Nobody perceived that there was risk to the market. But what was I telling everybody in the chat room and in the posts and margin of safety and fundamental trends? I was telling you volatility was about to pick up. Here's the reasons why, and that we should be hedging our bets a little bit. We bought some volatility calls, and we bought some puts on the S&P 500, and I know that the most aggressive traders made hundreds of percent. I didn't make that much because I'm just trying to make some money around the margins around my long positions, but there are ways to quantitatively figure out, and I've showed you my quantitative charts before, when the market is getting a little bit jiggy, I would call it, when it's getting a little bit wiggly, and that wiggly could get worse. So I sell a lot of cash secured puts rather than buying stocks initially because it generates me income and it helps me set a limit price. So let's walk through the mechanics a little bit. Generate income with cash secured puts. Selling a cash secured put. Essentially, a put, if you're the seller, obligates you to buy a stock at a certain price. If you are the buyer, it gives you the option of forcing somebody to buy your stock or buy stock at a certain price. So in this case, in every case, if you sell a put, first of all, start with an underlying premise. You are willing to buy the stock at the price, strike price, minus the premium received. Never sell a put on a stock you don't want, right? So start with that premise. I would like to own Micron. I would like to own Exact Sciences. I would like to own Nutrien. I would like to own some of these stocks. And at today's price, I'd probably be happy buying those at today's price. However, I can set a limit price a little bit lower, and that's pretty good, and it might get hit. Or I can essentially set a limit price by selling a put with a strike price equal to where I would set the limit price, and I get paid to do that. Pretty cool, right? So let's say I want Micron at $50 a share. I think that's about where it is right now. I could buy Micron today at about $50 a share, or I could sell a put on Micron at, say, 49. And somebody might pay me $2 to do that. So instead of buying Micron today at 50, in the next 6 weeks or so, let's say the option goes out to May, I would have the obligation to buy that stock at 49, should it be trading under 49. But remember, I've got $2 a cushion or $3 a cushion, whatever the put cost. And I've received that money day one. So I generate an income, and I didn't have time to put an example in here because I just put this together. In the future, we'll really go into an option presentation. But selling cash secured puts, if you go to the CBOE and you learn about it, essentially is letting you set a limit price a little lower than today's price for a month or two out, and you collect premium doing that. If you do that over and over and over again, you're going to generate probably a double-digit percentage in premium every year to your portfolio. Last year, when we had the blowout year making 48%, about over a third of that money was made just selling puts. It was a pretty good deal. So, this wasn't meant to be a really full-fledged, selling cash secured puts presentation, but this is something that you really ought to think about. Is if I can set a limit order, or I can set a limit order and get paid to do it, which one would you rather do? You'd rather get paid to do it, right? Yeah, I don't think anybody wouldn't. So selling cash secured puts, to me, is like setting a limit order and getting paid to do it. And then here's kind of a cycle that I follow. I don't sell a lot of, yes, you can sell a cash secured put in an IRA as long as the cash is in the IRA. That's why it's cash secured. You don't need any margin to do this. So here's the cycle that I follow. Sell a cash secured put. Sell the put slightly out of the money or slightly in the money, depending on how much you want the stock assigned to you. So if you are trying to get the lowest price, you'll write the put a little bit out of the money. So again, in the case of Micron's $50 stock, out of the money means you write the put at 47, 48, 49. In the money means that you write the put at 51, 52, 53. Why would you ever write a put in the money? Because you really want the stock. You just wanted it at a little discount. So, you check your math. You say, okay, the $53 put on Micron, even though the stock is at 50 right now, is trading for $6. Gets me a net cost of 47. Because it's in the money, it's much more likely to get assigned to me. I might do that. I did that recently on Sierra Wireless. Sierra Wireless was trading at about 17. I wrote a $17.50 put on Micron, got paid $2.50. My net cost on Micron, if it gets assigned to me, will be 15. Right now, Micron is trading in the 16s. I hope it gets assigned to me. I hope it's $17.49 on the day of expiration, and I basically have a $2.50 gain day one of owning the stock. So you can manipulate your strike prices depending on how much you want to own the stock versus how low you want your cost basis to be. With Sierra Wireless, I think the cost basis is pretty darn low already, so I really want to get the stock. Micron, I'm writing a little out of the money because I do think the big support is down in the lower 40s, so you might see lower 40s on Micron. I don't think the analyst at USB who talked about it going to 35 really understood what he was saying. I mean, I really just think it was a bad analysis, but it's a volatile market. Doesn't mean it can't happen. All right, so let's suppose a stock gets assigned to you. A lot of people want to immediately write a covered call. No, don't do it. Resist the urge to write a covered call right away. But eventually you might write a covered call. The reason you don't sell a covered call right away is because these are good stocks. We got a good price on. Wait a bit until the stock is overbought sometime in the future. Let your winners run. That is the key to making money in the stock market. You have to let your winners run. So your best stocks, the ones that are going up, wait for them to stop going up before you write the covered call, right? Let that momentum play out. Let the chart get a funny curve. Then write your covered call. And then you might lose the shares. And if you do, that's okay. Why? Because you let your winner run. You collected premium here. You collected premium here. Now you lose the stock. It's in an overbought condition. What happens after something's overbought? Usually gets sold off a little bit. There's some consolidation. During the consolidation, you sell more cash secured puts. Rinse and repeat, right? And this whole process can take a while. It's not going to take 3 months. It could take 2 months for this option to expire and get assigned. You let the stock run for 6 months, then you write another option for a month or two out. I mean, this could be a full year process. And inside of an IRA, this is an awesome thing to do. Why? Because you're essentially trend trading within a channel and collecting premium twice, and you're owning the stock, buying it near the bottoms of the channel, selling it near the top. You'll never be precise. You'll never get it perfect. But by taking a little profit at the bottom, taking a little profit at the top, then buying it back a little lower and getting paid income twice, it's like building in a dividend. To me, this is the best IRA strategy that exists, bar none. Bar none. If you're going to own stocks, this is the way to do it because you're adding income here, you're adding income here, you're letting your winner run, and you're selling in an overbought condition. Now, you need to understand what overbought is. Simplest way to do it is use RSI, right? Relative Strength Index. That gets up over 70, you probably write your covered call, because RSI rarely stays over 70 very long. And it rarely stays under 30 very long. Simplest measure you can use. Use a little bit of MACD. I like Chaikin money flow because it tells me whether money's going into or out of a stock. All right, so I have some people here talking about how they've been selling cash secured puts in their IRAs. Yeah, and so after we get a rally, so when this S&P 500 gets back up to 27, 28, 2,900, maybe 3,000, as I believe is going to happen, I think we're going to see S&P 500 3,000 by the first quarter of next year. And then by then we'll have to deal with the reality that tax stimulus and Fed stimulus and ECB stimulus are all going to be wearing off, and that Japan's just not that in that good a shape. Eventually Japan's going to fall out of bed. I don't know what year it'll be, but it'll be eventually. And when Japan falls out of bed, the world's going to get a headache. So I'm thinking that's going to be 2020, 2021, but we'll see. Hopefully it's after we're all dead and gone. Hopefully it's not for another 100 years, but it's probably coming. So in any case, I like this approach. I think that if you do this on a regular basis, you're going to generate a lot of income. You're going to let your winners run. But remember, just don't be in love with the whole selling covered calls thing. I warn people about covered calls. Why cut off your winners? Why not let your winners go up another 10, 20%, right? To collect 2 or 3% in premium? No, let your winners run. That's why I made a ton of money on Exact Sciences. I knew that it should go to at least $30 and maybe $40 a share. It blasted all the way up to 60, which was, the range that I had for a couple of years out. So, it's pulled back since, but when you get a winner that's running and momentum is there and there's money flow, you can measure that there's money going into the position, and there's not many sellers, right? These are all quantitative things that we can measure. You need to be aware of that. So let me answer a couple questions. I'll go through the chat. Yes, that's so the cat that you see on my computer screen, the cat and the dog I have, the cat, we adopted out because my house burnt down a couple of years ago, and where I was living, they couldn't have a cat. So I adopted out the cat, which was fine with me because I was allergic to her, loved her, but she's with a couple of nice little kids now. And, she'd be 16 or 17 right now. So, maybe she is, maybe she isn't. In any case, that's the cat question. What's your take on ENB on Enbridge? I like Enbridge and Kinder Morgan, I think, are the two premier big pipeline companies. And then there's some other ones out there, some smaller ones, some Permian-based ones. The one that Fang is spinning off, Viper, they're changing from the MLP structure to the corporate structure. There's definitely good buys in the MLP space as they get rid of their the rights, the distribution rights from the limited partners to the general partners and switching to the corporate structure. That under the new tax code is pretty advantageous. So, the nice thing about a MLP is that if you own it in a non-tax qualified, in a taxable account, you can use the K1 to get some tax break. Inside of an IRA, it actually can break your IRA if you have too much unrelated business income, UBI. So you really got to be careful about using MLPs in an IRA. Talk to your accountant before you do that. I use the AMLP ETF, right? Because I don't like the exchange traded notes. We've seen what can happen to those blowing up. But AMLP, somebody wrote a paper about it's got some hidden tax issues. It doesn't. It just doesn't work the way that they described it. Will it trail the actual index just a shade? Yes. But is it going to trail by, I think this guy was talking 20, 30%? No, not even close. You're talking maybe, a 0.5%. The tracking error is pretty low. You see that. Just put it up on a chart. Tracking error is pretty low. In fact, why don't I do that? So, we'll do that at a different time. We're on schedule for once, so let's do that. What's your allocation to QQQ at this point? Depends on the portfolio. If you are an ETF investor where you're only doing ETFs, it's hard to ever have less than a quarter of your money in QQQ, and then you can go ahead to increase the position when it gets cheap. So, you can have a QQQ position up to half if you're an ETF investor. Right now, I don't have anything in QQQ, right? Because I was afraid of Facebook and Netflix and a couple of the other ones, and they've come down. So the first price point to buy QQQ is about 152. I'm not looking at it right now. All right, so we'll see. It's at 159. Yeah, it's tough. At its low point, it got right on top of its 200-day moving average. I think that's a buy point. But, the world is still expensive. There's still pretty high valuations. 200-day moving average, I think we're going to bounce off of. I don't know that. The low is a little bit higher than the last low. That's a positive sign. So that's telling me that unless something goes haywire with these tariffs, we're probably going to rally here at some point. I don't know when, but in coming months. All right. Micron got hammered yesterday. What are your thoughts? I think I already told you. I think it can go down to the low 40s, but I'm pretty happy buying it around 50 as well. AbbVie, I have a problem with the entire healthcare sector. I believe that there's going to be a massive, massive bear market in the healthcare sector in coming years. I don't think that the governments of the world are going, especially the U.S. government's not going to allow healthcare to depress the economy. Eventually, businesses are going to step up and say, look, we're getting killed on healthcare expenses. Government's pro-business, both parties, not just Republicans, both parties are pro-business. I don't think there's any doubt about that. So I don't like most healthcare stocks in general. AbbVie is one of the companies that I would buy, but I would need to see them down in the 70s, right? So I just don't think it's a hugely attractive stock at this price level. I mean, is it an okay stock? Yeah, I guess it's okay. Could you trade it with the averages? If you're a good trader, you could. But to me, the really good support on AbbVie is in the low 70s, and that's where I would look to get it. What will be the impact of tariffs on energy stocks? Well, the tariffs, if they go through and if they slow down the economy, will be bad for everything. But as I said earlier in the conversation, I think there's a very good chance that you have President Trump cut a deal with China. China is the biggest importer of natural gas and oil in the world now. What are we starting to export? Natural gas and oil. Put 2 and 2 together. He wants to get 50 billion or 100 billion off the deficit, right? Or million, whatever it is. Why don't we just get them to agree to buy more oil and gas and some marginal improvements around, access to their markets, and, have them promise us not to steal as much technology, right? They can promise. Wink, wink, they'll promise. They'll promise not to steal technology. Technology, once it's a year old, is not that big of a deal, right? Because there's always something new coming. So, you just can't keep technology away from anybody. Can you delay it? Can you slow it down? Sure. Can you get them to respect patents a little bit better? Sure. But these are marginal things. These are things at the margins, at the edges. I think ultimately this is about selling oil and gas to China. And I think that's going to be part of the agreement when it happens. Do you spend any time thinking about margin debt and how that plays into the mix? No, I never think about margin debt. Why? Yeah, okay, I'm just kidding. I really do. Yeah, margin debt's a problem. I just saw a chart recently that it's getting to be pretty high again. I might even be at a record level. The thing to consider about margin debt is the counterparties and the people involved, how deep their bank accounts are. So I don't believe that it's a whole bunch of, poor kids, who are trying to make a fortune borrowing on margin. I think these are bigger players for the most part, and I think that they have it largely under control. Now, that doesn't mean that the sell-offs can't be wicked, right? The computers turn on you. You're going to have to start covering your margin debts. And we saw some of that. We saw a lot of that with the volatility shakeout. So, yeah, margin debt is a harbinger of a problem developing. I don't think the next big correction, the big bear market that everybody's afraid of, the 2008 redux, I don't think that's coming for a while. But, Can it make a difference when it comes to your ebb and flow trading, right? Your positioning, your slow upgrading of your portfolio, your slow constant upgrading of your portfolio. Yeah, keep an eye on margin. And when it has a little spike, be careful. And it's done that recently. It's come off a little bit now. And we'll see if it goes back. And then again, yes, you can sell cash secured puts in an IRA. I think it's a great strategy. You'll have to liquidate some stocks or funds to make sure you have the cash. The reason you have to have the cash is in case the stock gets or the ETF gets put to you, right? So it's called cash secured for a reason. You've got the cash there to buy the stock if it gets put to you. Does Sierra Wireless have a competitive advantage? They have They have the biggest margin share in their space. Do you think they have a competitive advantage if they have the biggest margin share? Yeah, they have a competitive advantage. One, there's barriers to entry, right? And then there's technological barriers. It's not like I can just go into my garage and make the I call them connectors. That's not what they're called, but the bridges out into the internet, into the cloud. It can't be done. Now their OEM business is going to slow down and keep slowing down. But where they're going to really expand is as a more pure internet play, and they're growing at what was their rate? They had a really, really good growth rate on that. So, but they lost a real big OEM. So contract, I think it's just reduced. So yeah, I think this Sierra Wireless has a pretty big comparative advantage because it's hard for anybody else to jump into that space and take that market share, right? They have all those endpoints already. What about BYD Motors as an EV play? In general, I think the world will go to EVs pretty heavily by 2030. However, and when I say that, I mean new car sales will be more EV in 2030 than gasoline. But it'll take another 10 years for retirements. I've had the chart up in my articles about how I think that's going to impact oil supply, oil demand. Oil demand keeps going up through the 2020s, levels off, and then turns over in the 2030s. I don't like the actual car manufacturers for the most part. I like Volvo for other reasons because of the trucks. Tesla, I've said I would buy it if it gets down into the middle 100s. It didn't quite get there this time. But I have a problem with the actual car companies because they're so incredibly capital intensive. I think you're better off going with the ancillary plays, the companies that make the parts, your whole picks and shovels argument, and who's going to connect you to the internet, because all these cars are going to be connected to the internet, IoT. That's Sierra Wireless. You take a look at Intel. Intel is the rare dividend paying stock that actually has some growth. Are they going to grow like Micron? No, because they're already huge, right? So smaller companies will grow bigger because they have more room to grow. Intel, again, and Intel doesn't do DRAM. Intel has bought Mobileye, some AI stuff. They're going to lose a contract like Apple probably, it sounds like. But to have a company paying a fat dividend like Intel, where is Intel here? What's their dividend? 3 something? 2.5, 2.5% dividend on a company that actually has a real growth rate. That's a dividend growth stock, right? The difference between dividend income and dividend growth is that a lot of companies out there pay a dividend, but if the stock, if they don't have rising revenue and rising EPS, they're going to have a problem raising that dividend in the future, and at some point they could have a problem. So companies with actual growth rates are the best ones for paying dividends over time, even if the absolute dividend's a little lower today, right? Because it's going to be more secure and it's going to grow. But as far as going back to the EVs, man, I have a hard time with all those companies. I think GM and Ford are bad investments. Toyota, I think, has a shot. They're on my international list of companies to keep an eye on. The reason being is that they're a leader in hybrid technology. In my experience, having driven EVs and hybrids, is I think EVs are going to do pretty good as passenger cars, but I think hybrids are going to dominate the SUV space. And what do we like in America? We like SUVs. So, I'm dying for the Toyota 4Runner hybrid to come out next year. Dying for it. That's going to be only the second new car I've ever bought, and I'm waiting for it. I have a 4Runner SUV with the sports suspension, hard to find, and I love it. And I'm going to get one that's a hybrid. Why? Because I'm going to get an equivalent of 35, 40 miles to the gallon in an SUV. I mean, that's pretty good. And I do expect gasoline prices to get back into the threes this summer and then probably stay there. So, I think that's going to drive EV sales, but I think there's going to be incredible competition. I think there's going to be a ton of CapEx that has to get spent. I think it's just going to be a tough market for these car companies to make money in. Any good strategy for a 401k? Well, it depends on the 401k. Yeah, John, I'll get to you in a second. For 401ks, it depends on what you have available, right? Do you have 12 funds that are available, or do you have a really big menu of funds like Fidelity? There's a hospital system here in Wisconsin, and I know a lot of places around the country, they use the Fidelity funds in their 401k, and they might have, 70 funds available, including the sector funds. So you can do an awful lot, right? So if you have something like that, you can do a really good asset allocation strategy. And then there's people who have a brokerage window. Most brokerage windows in a 401k don't allow option trading, but they do allow stocks. So, I generally don't, unless you're really going to be involved, I don't generally advise stocks in a 401k unless you're truly going to manage it hands-on and make sure you're buying really good dividend paying or really cheap growth stocks. And that is the trick on growth stocks, by the way, is we want to buy growth stocks at value prices, right? You want to catch them before the crowd does. So you can measure, hey, revenue's going up. Hey, they're gaining market share. Hey, their price to book is low. Things like that. So John says, in a big drop, a cash secured put can make you realize an instant large loss. Kind of, but doesn't a stock do the same thing? So if I buy Micron at 50 versus selling a put at 47, and I wake up tomorrow and the stock is 35, where did I lose more money? Right? Where did I lose more money? Because I can put a stop loss on either thing. I can put a stop loss on the stock. I can put a stop loss on my option. Now, the thing is, if you wake up in the morning, which is the way it usually happens now, you wake up in the morning and your stop, has gotten, blown through, it doesn't matter. If only I sold the put, only a loss. If I only sold the put. Well, but that's not the equation. Your choice is to buy the stock or sell the put. You'll lose less money selling the put versus buying the stock if there's an overnight drop. That's just math, right? You could do neither, but if you want to own Micron, or, I'm just using that as an example, if you want to own a stock and you buy it and you wake up the next day and it's 50% lower, it's no different than if you sold the put. It's the same thing, right? It's the exact same thing, because you're going to get the stock put to you minus your premium, so you actually lose a little bit less. So selling a cash secured put, not margined, but a cash secured put, is less risky than buying a stock by the difference in the premium received and the difference in the strike price versus the current price. So if you're chronically and repeatedly selling puts a little bit out of the money, you're always going to be putting money in your pocket, and you're always going to have a lower strike price than what you would have otherwise bought the stock for today. That's right. And there is a corresponding hedge. So Kelvin was talking about that. You can buy puts to protect yourself as a hedge. And you can do spreads. Yeah, there's all kinds of stuff that you can do. in most cases, there's no point to doing it, right? So if you have a stock like Micron where you believe that the very strong support is around 40, right? Which is what I think it is. I think there's very strong support around 40. I can see that in the charts and in the cash flows. Why wouldn't I sell a put to the middle 40s, collect some premium versus buying the stock today? Yeah, it's a pretty. I knew what you meant, Kelvin. It's just pretty logical math. You know, there's not much more to be said about that actually. Selling cash secured puts a little bit out of the money is safer than buying the stock. That's because you're collecting money and lower buy price. All right. Anything else today? I would say this: if the market is crashing to the end of the day and it's going to close below the 200-day moving average, and I'm not even looking at the market right now, so let me take a look. Okay, so it's not looking very good right now. Let me share a different screen. Give me 2 seconds. All right. All right, so I just put up the chart of the S&P 500. So it's at 263 right now. The SPY is at 263. S&P 500 is at like 2630. If this market just gets crushed here at the end of the day in the afternoon, and it looks like we're going to close below 258, then there might be a lot of follow through next week to the downside. You know, we could realize this area here. So it really is important to watch. Today is a very, very important day. This is an important market close. If we lose 5 more points on the S&P 500, that's a problem. Let's go over to QQQ. $159. So 153 is the level we gotta be worried about. If we're crashing down below 153, that's bad news. Right? We're on the weekly. This is the close of the week. Weekly charts are more powerful than daily charts when it comes to a broad trend. DIA 241, 234. Yeah, we'd really have to see a huge sell-off this afternoon to have this chart really turn negative on us. Doesn't look like it's going to happen right now, but I don't know what's going to happen in the next 3 hours. So we'll see. But again, if you're concerned about playing defense and you start seeing this market just selling off huge later in the day, you might want to close out some of your higher risk stuff. You know, I will, for a brief moment in time, pull up the VSL. I don't want to show everybody our stocks, right? Lots of stocks. Right now, 25% in cash in all the models, except for the retirement income options, which is half in cash. But again, half of that is securing puts. So, you know, use this as a broad guide. You know, these are the asset allocations, and then you're going to fill it with things that are either here or in our ETF, you know, our ETF chart. Now, I'm not done with the ETF chart. You know that I've been working on this. It should be done here shortly. But, you know, mind your asset allocations. It's okay to not be fully invested. I know that a lot of people like to be fully invested all the darn time. I'm just telling you, that's never been what worked for me. I am chronically between 10 and 25% in cash. And right now I'm closer to 25, you know, around 25. And then about half of that is securing puts right now. And a lot of times, even with my punch card stock portfolios, I'll actually go 50% cash in the punch card stock portfolios, but then I'll write a ton of, cash secured puts. It's harder to do in 5-figure accounts, right? In 5-figure accounts, you can't do, $100 stock, because it just becomes too, one put is too much of your portfolio. But in 6-figure accounts, you can use the punch card stock strategy and then, but use the retirement income options allocation, at least on the cash side. So, really for most people, I consider punch card stocks to be 5-figure portfolios. And then you move over here for 6-figure portfolios, and you'll just, it'll just revolve around your choice in stocks. The retirement dividend income, I honestly, I don't use it much, but I know there's a big demand for people out there who don't want to deal with options. Once again, I implore you, learn how to sell options. Selling puts and selling covered calls, is just, I showed you that chart earlier. It's a great process. So, but if you just want to be in dividend income stocks and you don't want to, trade any options around the edges, that's fine. But I do think that even you should be a little bit more conservative right now. The market is expensive. We've seen all the valuation arguments. We know the economy is pretty good though. So you got tax cuts that are being offset by trade talk. What ends up happening there? I think the trade talk gets settled. I think we get a rally, and then a couple years out, the big one. Any last questions, or can I call it a day? All right, we're going to call it a day. Have a wonderful weekend. Keep your eye on the market at the end of the day today. If it's really crashing hard, you might want to dial it in a little bit. Have a great weekend.